Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Boyle, Fixed Income Asset Class Specialist at Hartford Funds, to discuss how cash and fixed income performed in higher interest rate and high yield environments and what that means for investors today. Joe, it's great to have you with us. Welcome to Trade Talks.
Oh, thank you for having me, Jill.
You got it. Historically, how have cash and fixed income performed in higher interest rate and high yield environments?
Yeah, generally speaking, cash tends to lag other sectors of the market. 2022's cash outperformance is more the exception than the rule. And year-to-date, cash is outperforming higher quality bonds, and it has created a little bit of a separation given this recent backup in rates. But more income-focused strategies like a high yield or emerging market debt, they're well ahead of cash and as well as equities. What it really means for investors is cash has been a real source of return for some folks now for the past year and a half, which has been very nice and hasn't been the norm for the past 20 years. But it may last a little longer, but eventually we expect that to get outpaced by higher quality bonds, and that move could be meaningful.
Do you see a momentum shift coming from money market accounts and CDs to bonds? And to follow up on that, are bonds set to outperform cash in the near term then?
I think there should be a momentum of flows out of cash into bond funds, but I don't think everyone will do it. You know, as I said, cash is outperforming high quality, and a lot of people like that, but they might not be looking at the whole picture. What high quality bonds are offering you today, and what they haven't in a number of years, is an equity hedge, potential protection to some sort of risk-off event. That could be this recession we keep hearing about, or that could be an unknown event that always seems to pop up when we least expect it. You now have a cushion in high quality bonds with rates having backed up so much to see some decent pickup and protection if the market does turn against us. You don't get that with cash. In fact, cash rates will go down in the event of the risk off event, which is really kind of the double whammy for you in that scenario.
So as an investor, if you're exploring the strategy to transition from cash to core bonds, what considerations should you take into account with the strategy, especially in different rate environments?
Yeah, I mean, obviously, you need to start with your risk tolerances and objectives. If you have near-term cash needs, it absolutely makes sense to stay in cash. You're getting a little return and you have the liquidity you need. But if you intermediate to longer-term goals, there's a lot of better options out there than cash. You know, high yield and lever loans are up significantly year-to-date, well ahead of cash. But if the market takes a turn, and depending on the degree of that turn, spreads would widen out and you might get some of that back. Even in the core and core spaces, I've been talking about high quality, you need to make sure you know your manager. There's a lot of funds out there that, although they're labeled core and core plus, they might make some outside bets or take some outsized risk that you might not be comfortable with your core allocation. So really, keep everything within the framework of your risk tolerances and objectives. You want to know what you're buying, but really who you're buying. What does the manager really do?
Mm-hmm. Let's think about this from a macro perspective. Where do you think the bond market is headed, and how would you advise investors given the current economic landscape?
I mean, I think this is a really great space for high quality bonds. You're getting similar level of return as cash, plus the added benefit of an equity hedge, the risk off event. We are likely closer to the end of the Fed tightening cycles. And historically, that has meant strong future returns for bonds and bond funds. And if nothing else, we like to say the bonds, they self-heal as long as they're not a significant uptick in defaults. What I mean by that is the 2022 rate backup put a lot of high quality bonds at a discount, and you really are an attractive entry point. So you have this potential for capital appreciation in high quality bonds that you haven't had for quite some time. So you're keeping up with cash, but your potential to surpass cash, especially as you said, in the lens of the economic environment with the Fed potentially near the end of their tightening cycle, makes a lot more sense to start legging into some higher quality allocations.
All right, Joe, we appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.
Thank you for having me.